Hello and welcome to the S&P Global Platts Oil Markets podcast. Today we're going to be talking about how rising bunker fuel costs have left ship owners scrambling to make ends meet, with freight rates hitting lows during the seasonal summer lull. I'm Tamara Sleiman, Managing Editor of Residual Fuel Oil Markets here at Platts. On the podcast, I'm joined by Britt Russell-Webster, Associate Editor for Marine Bunker Fuels, and Chris Toh, Associate Editor for Tankers on the shipping desk. So, we've definitely seen freight rates drop to low levels before, which Chris will touch on in a bit. But the focus this time is more on how high bunker fuel costs have been lately. So Britt, to start with you, what would you say has happened to marine fuel prices recently?
So we're actually 1.5 years into IMO 2020, which is arguably shipping's toughest regulatory change to date. So just to give perspective on this dropped the sulfur content limit on marine fuels from 3.5% to 0.5% in order to reduce sulfur emissions from the shipping sector. Because of this and because of COVID, there are actually many impacts from the regulatory change that have been muted, and one of those is definitely price. So fuel prices last year were basically half of where they were in 2019, despite this regulatory change. This was definitely softening the blow on depressed freight rates in the shipping industry. But now we actually have this very different scenario, where fuel prices are over 80% higher than they were last year. Again, you only have to go to the nearest gas station to fill up your car to notice the big difference. However, paying 130 pence per litre for gasoline at the gas station isn't uncharted waters, but the shipping fuel and where it's headed at the moment, we are currently at 16-month highs, and where these were short-lived due to this demand surge for lower sulfur fuels, this time round the prices have been gradually increasing, and the last time buyers had to pay over $500 per metric ton for fuel was back in 2014. So generally speaking, shipping sources say that marine fuel is approximately 60% of total operational costs, which is already a big chunk, but if those prices are to increase, we could potentially see that percentage of total operational costs increase a bit more. But if we look a little bit closer at the marine fuel prices, there hasn't actually been a big boost in market conditions for the fuel sector. Demand has been actually largely unchanged from last year, and in some cases we've actually seen European regions that have too much product to go around. So the main reason that fuel prices have risen is mainly due to the oil complex in which the market is intrinsically linked to, and that's kind of dragging the prices up. If we look at oil prices and the reason as to why they've risen, it's mainly due to the fact that, people are driving more in the US and Europe compared to lockdown. They're burning more gasoline, and that's boosting sentiment for the complex. So actually kind of looking a little bit closer at the data, we can see that bunker prices are actually kind of dragging their heels compared to the rest of the oil complex. Even though, ship owners and charterers are having a bad time, it could be worse for sure. Crude oil has risen around 9% in the past month, whereas marine fuel has risen just under 8%.
I mean, yeah, as you said, it could be worse. We were expecting bunker prices to increase by threefold in 2020, but obviously COVID gave ship owners a bit of a grace period, you could say, and they didn't really feel the full impact during 2020. So, Chris, based on the feedback Britt just gave, how would you say the recent firming of bunker prices has impacted tanker ship owners?
Hi, Tamara. Well, yes, as Britt was explaining, really, in terms of the bunker prices, they had been up in the current markets for 16-month highs. But what has happened in 2021 is a lot of the flat rates that ship owners kind of, look towards as their potential, gold mines in terms of their earnings and what they could be. They've all been down on the year. So what we are now experiencing in terms of the markets, tanker markets themselves, is what I call the pinch, really. And that is, firming bunker prices coming as, severe overhangs for time charter equivalent earnings for ship owners. So that's how much money they make per day. And, the downward sentiment in the markets overall, which is obviously something that typically happens in the summer lull. A lot of people believe that maybe this year would be a very different year with the restrictions and lockdowns easing, but it seems that the summer markets is still a thing that happens in tankers, and therefore we're now getting into these really dangerous areas where earnings are kind of like head above water for both dirty tankers and clean tankers. In clean tankers, we're very nearly there. A lot of owners kind of explain that if not enough cargoes come out and if freight rates go down continuously more, then they're going to be in the red in terms of negative earnings for their vessels per voyage. And sad to say, this is already happening in the dirty tankers markets. It's already happening on some Aframax routes and definitely for some VLCC routes, which happens. These markets have been very, very stagnant and lifeless, so to say, in terms of earnings on the world scale level. We do actually have, we launched new TCE calculators in the dirty tanker markets, which suggest that cross UKC Aframax rates are now earning something like minus $1,768 per day, which is awful. This is something that ship owners can't really sustain in the medium to long term if they're making these voyages where they're supposed to be earning money on their assets and they're just simply losing money. So this is what's happening right now, is the downward pressure from markets due to lack of cargoes and the pressure coming from the bunker overhang, just hanging over their heads.
Thanks, Chris. And if there's one thing we all know, is an angry ship owner is not a fun situation to be in. When the losses are big, it could be a very stressful market to be in. So I guess my question would be, how do ship owners typically combat this? You know, how do they deal with this when earnings are so poor? Are there any strategies that come into place?
Yes, absolutely. But this is where we get a bit of a dichotomy in terms of owner strategy. So, let's start off with what they can do with the rates that they're getting. They could basically kind of lock out or kind of blank out certain routes that just, because of those flat rates that I mentioned earlier, they're very, very poor returns in line with those increasing bunker prices. Some owners will say they want to keep their vessel with as least lay days as possible. So they want to keep their vessel moving really long haul routes, getting those very attractive flat rates and keeping their vessel going. In the long range tanker markets, that actually is a bit different. So, for example, one of the benchmark routes for Mediterranean to Japan for naphtha, we have some ship owners who are just saying we can't make any money if we're doing these, the current market levels, because of the bunker prices. And therefore they just pretty much dig their heels in and say, we're not doing this unless we get more. We'd much rather go down, take some gasoline or gas oil down to West Africa and sit on demurrage, which, can give them potentially up to something like $22,000 per day on that. So you start to see a very kind of skewed picture on what ship owners are willing to do in terms of routes and what they're not willing to do. But this is where it gets a bit dirty. If the market does indeed go in the red and you're seeing, a blanket overall conditions where all routes, they're not earning any money, they're actually losing money. Some ship owners out there would, hold, certain principles in that they will not fix any cargoes at certain levels and they will simply sit on their bunkers, burn them idly and wait until the market improves. But then you have some out there who say, no, their ships are obviously, financial assets. They have to keep them moving. They have to continuously keep their vessels busy, despite the fact that they're, making negative earnings on their vessels. And they're the ones who sort of depress the markets in this level. So, there is a bit of tension there because you have some ship owners who will say, no, these guys will continuously keep the markets at depressed levels if they keep fixing there. And, on the other side of things, it's like, well, I can't possibly just sit and burn bunkers. You need to keep the vessels moving due to the length of your tonnage list, for example. And this potentially is on the horizon for the clean markets and probably is already going on for the dirty tanker markets.
And from my understanding, basically when you're dealing with a depressed market, typically you would see some ship owners take their vessel into dry dock. Is that an option as well? Take advantage of the fact that they're basically operating at a loss. Would they look to take their vessel to dry dock and basically do all the maintenance checks you would have to do to be in line with your class and flag qualifications?
This is something they could definitely explore in terms of their strategy, but obviously you have these big pool owners who, have numerous vessels in their itinerary, numerous vessels that they have to handle, and, they could look to take some away from the markets. It's all about, taking as many vessels away from the markets as possible at one particular time when you're trying to combat these very poor, rates, which are, generating negative earnings. So yes, and that's definitely something that some ship owners do. But a lot of them would like a kind of a delay in terms of what they have to do with their vessel. Quick turnovers are not attractive. When your vessel goes over only for like 5-6 days and then they're back open, this is where you have to consistently think about what you can do with it. So you actually want to end up discharging at a port or, sitting at a port where you have many more options. And as I mentioned previously, West Africa with obviously the demurrage play there is certainly one of the more attractive options, because you'll just be sitting there earning money, not having to worry about a thing for the sort of near to medium term.
Okay, great. Thanks for that, Chris. And Britt, taking it back to you, if kind of want to look ahead a little bit. So what would you say the expectations are for the marine fuel market for the rest of the year?
And the climate for the sector is actually expected to pick up, even though it's obviously pressurised at the moment, as Chris was saying. It is expected to get more positive moving forward. That, of course, is linked to the fact that international trade is expected to resume as the impacts of COVID-19 soften. So the result of this would be, you'd expect more demand for bunker fuel to come in and the freight rates to get a bit of a boost. At the same time, crude oil prices are already at multi-year highs, so many analysts aren't actually expecting crude oil prices to go much over, if over at all, over the $80 per barrel mark, which, if this is the case, that would then filter down to the marine fuel prices as well, and you'd expect to see a ceiling there too. So this, in that case, would mean that there would be a little bit more breathing room for the ship owners and the charterers going forward.
Great. And just one last question for you, Britt. There's been talk around a carbon tax on fossil-based bunker fuels recently, and I wanted to get your input on how this would impact the shipping industry. How will it play out? Because obviously there's been talk around the future fuels to move to, a greener world in the shipping industry. If you could give us a little bit of a background on how carbon tax on fossil-based fuels would come into play as well.
Yeah, so, we're speaking about uncharted waters for the shipping industry in terms of costs of bunker fuels, these really high prices. But of course, that is going to change again as the industry looks towards greener targets too. So as you've said, one of the ways in which the industry is looking to achieve this, or could look to achieve this, maybe could be through the way of a carbon tax for the most polluting culprits. Because at this moment in time, one of the big barriers for moving towards newer future fuels is definitely the price side of things. The fact that it's way more expensive to burn these newer fuels than it is to burn oil-based bunker fuels makes that switch over a little bit harder. So if you had this carbon tax, it could bridge the gap between the two fuels. And that's certainly what some industry players have called upon the IMO to do. So, for example, Maersk, who are the world's biggest container ship company, they've called for $150 per CO2 metric ton that each metric ton of fuel emits as a tax to be added on to the top of the bunker fuel cost. Approximately, this would actually take the cost of oil-based fuel up to around $1,000 per metric ton. Just to give a bit of perspective on that, marine fuel prices have only breached $700 per metric ton back in 2012 and 2008, just for a couple of months max. So we're definitely talking about uncharted waters going forward. And, even with this tax, because LNG is a fossil-based bunker fuel as well, it would be expected to be around $900 per metric ton. And also with that, Maersk are looking to back methanol going forward as a future shipping fuel. And if that was taxed with this, the emissions and the total tax on top of that would be around $580 per metric ton, which is still even more expensive than Rotterdam's prices at the moment. So basically, there's actually a lot coming up in the future. And I'm sure there'll be lots more discussions about prices going forward. And it's definitely not fading into the background, this discussion on bunker fuel prices.
No, definitely. It's definitely not the end. These new regulations that the IMO has set is definitely going to cause, I don't want to say uproar, but it's definitely going to be bigger than IMO 2020, I feel. But I guess that's it for today. So thank you very much, Chris and Britt, for your insight and time. And thank you all for listening in. Stay ahead of the evolution of energy at Platts Live, the new professional platform built exclusively for the energy industry. Have your say and join the conversation at plattslive.com.